Good day, everyone, and welcome to Forex Street webinar. Today is 20th of October 2015. My name is Nenad, and today I will show you leverage, over leverage, and position size calculation. So basically, I will explain about the leverage, about why you should never over leverage, and how to calculate position size. So that will be a very important part of teaching, because ultimately it all boils down to proper money management in Forex. Before I begin, as always, standard is disclaimer, stating that online educational materials are available at Admiral Markets Estonia for a global audience. And to get a corresponding information on charting conditions and any other detail, you should visit admiralmarketsglobal.com, then select your country and contact an appropriate entity. Also, there is disclosure statement stating all possible risks associated with Forex market. By accepting the risk, you're also proceeding further with me. And final part, explaining that Admiral Markets UK Ltd takes no responsibility for information accuracy. The analysis is my personal opinion, and this webinar is for informational and educational purposes only. Okay? And for all of you who are trading with Admiral Markets, of course, you can get up to 50% bonus on deposit. It will last for 2 weeks. Okay? Then no more bonus on deposit. You can download Admiral Market Supreme Edition by logging into Trader's Room, which is a great add-on for your trading, Admiral Market Supreme Edition. And if you're trading with Admiral Markets, you're trading with officially best MT4 broker. So today's agenda is leverage, over leverage, PIP value, and position size. Okay? So as you can see, money management is very, very important in trading, in your trading career. It's not just about talking about systems. It's not about having all sorts of different methods and systems. It's very important that you know how not to lose capital, or if you lose a bit of your capital, how to lose it within the risk threshold limit. So your primary task should always be not to lose a capital and stay on the flow for many years. Your second task will be gradually multiply your equity figures. And your third task is to earn profits. Remember this. Because problem with many people is that they set a third task for the first place. That's a mistake, because success comes down to proper risk management. It's always like that. So do not set the third task for the first place. Do it as I explained. Not to lose a capital, your primary task. Gradually multiply your equity figures, your second task. And your third task is to earn profit. Okay? Now, what is basically a leverage? Well, without a leverage, a lot of retail traders would not be able to trade. Traders in Forex market basically trade a contract of currency exchange rates. Now, as the movement of currency rates is usually very small, traders use leverage to increase their profit positions. Okay? So traders use leverage to increase their profit positions. Now, profit potential exponentially rises by using leverage, but also losses also exponentially rise if you don't know how to manage your risk. Brokers will provide you with more money than that is the balance of your account. Okay? And basically leverage works by establishing a rate you can use for every euro dollar in your account. The money you put for a trade is the actual money you risk. It's called a margin. Okay? It's called a margin, or the amount you risk. For example, if you invest $100 and leverage at 1 to 100, then you have 100 to trade for every $1 in your investment. If you start trading with your $100 investment, you can buy up to a value of $10,000. It's 100 times 100. Okay? So that is how leverage works. For every, let's say, if you invest $100 with 1 to 100 leverage, then you have $100 to trade for every $1. So you use it to increase your profit potential. For 100 leverage, you need $1,000, and then you would have a contract of 100,000. If you make 100 pips of a standard lot, it means that we made a profit of $1,000. That's because, as I already explained, for every dollar in contract, you made basically $1 cent. Now, if you make a loss and the value of contract drops to 99,000, the deal is off. That is because we traders guaranteed with $1,000, and the rest is broker's money. It's called leverage. Okay. Now, for all of you who haven't understood so far what leverage is, this is the scholastic example of a leverage. Okay. So let's say that you have $1,000 to invest, but you cannot trade with $1,000. You need a leverage. That is why traders who use at least $100,000 are called institutional traders, because also they do not require any leverage from the broker. Below that, they need a leverage. And especially if you trade with low amount of money, such as, let's say, $1,000, you definitely need a leverage, because you won't be able to make money. So, again, if you have $1,000, you guarantee with $1,000 at your broker. The rest is your broker's money, $99,000. If your account drops below it, you're stopped out. There is always some margin. So you need always to pay attention to margin. I will talk about margin during the webinar. Okay? Now, leverage exists to create a possibility of making bigger profits. It is very necessary, as Forex trading involves a very small price difference. It would take a very long time to make a meaningful profit or investment. So basically, by using leverage, you get a return of your investment faster. But needless to explain, leverage should be used wisely. It's very important to use it wisely. Leveraged ratio is based on the notional value of the contract. Usually it is domestic currency. Okay? So with such small amounts, as I said, $1,000, $100, it can really take a long time to make a meaningful profit. But if you use the leverage, you can get a return on your investment faster and using smaller initial deposits. Forex trades happen very quickly. And when you use leverage, you should always be careful. The leverage used, the more chance you have of losing your investment when the currency pair is going the opposite of your investment. Never ever risk more than you can accept to lose. Okay? For example, this is one of my trading accounts, and basically you can see how by carefully using leverage you can make a good profit. Can you confirm that you can see my screen? And just type yes if you can see it. And basically, this is the screen I'm sharing. Yes, it's confirmed. I'm sharing the details of one of my personal accounts, and you can see that the curve of the account is pretty much straight. Okay, it goes like I can say in a bullish pattern, right? It has some retracement here. Now we have jump, retracement. Overall, it's positive because you can see the curve. I started with $10,000, and at the end it was like 60% of profit. Now, the thing is, I didn't make a quick profit because my trading style, and the trading style I always teach people how to trade, is do it as institutional traders do. Do not listen to other retail traders saying that you should always make quick profits, that you should make 20% each month, because that is not possible in the long run. That will be very stressful to your nerves. That will be very, very... I need to say that one truth is ultimate. If you ever cross 5% of threshold, risk threshold, you're in danger zone. Believe me, I have tested it many times before, and I'm talking to you from my personal experience. The thing is, banks trade very carefully. Pension funds, institutional traders, big hedge fund traders. I worked for a firm back in 2010-11, and I know how it goes. Definitely, institutional trading is not the same as retail trading. But for the sake of your account, you should always take risk as institutional traders do. So my opinion is that you should never ever risk than 1% per trade. So proper risk is usually 1.5 to 1% per trade. And I recommend no more than 5 to 1 leverage. For example, if the account balance is $5,000, do not trade with more than 0.25 MT4 lots. Okay? It always depends on your risk, because if you risk low, you can afford bigger 100 pips or 30 pips. 0.25 you can use 0.10. Okay? So before every trade you make, you should calculate your risk. Your risk is fixed. Okay? Your stop loss is dynamic, and your risk is always fixed. Okay? You can see there was a drop in this account, and I made a drop unintentionally, of course, because it was my fault. I forgot to put a stop loss for one trade because I was managing a lot of things, and I forgot to put a stop loss, and look basically what happened. There was a dip in my account, not because I made a mistake in placing improper risk or I was over leveraging. No, it was normal leverage, standard risk, but I forgot to put stop loss. So stop loss is a must. Mark is asking how many lots is a standard institutional trade. Institutional traders do not trade in lots. They can open as big position as they want. So basically, how I did it, how we did it in while I was doing, we just placed a position. That position, one pip could have been $100 worth, could have been $50 worth, could have been $1 of worth, could have been $1,000 of worth. So basically, there is no lot. You just enter. That is at least how I did it. Basically, you enter the amount of money you want to go with a pip, and then you just watch go up or down. It's pretty stressful, I need to be honest, because that is big money indeed. We worked with big money, well, and every single mistake is very expensive. So, but overall, guys, if you're trading with $10,000 account, and let's say that your average stop loss is 30 pips, then it's okay to use 0.3 lot size. If you have $100,000 account, basically you can go easily, really easily, very relaxed with one standard lot. Because with one standard lot on, let's say it's $10, okay, $10. you can go with 100 pip stop loss each trade, and that accounts for only 1% of a risk. So basically, it's very important that you understand a proper risk limit. If I traded this account, for example, in a way how other analysts, educators teach us, probably it would have a lot of spikes and maximal drawdown would be much bigger. This is my maximal drawdown, and until I haven't placed my stop loss, my maximum drawdown had been around 9%. So actually, guys, it's all about your risk. You can have a good system, you can have a good method. Maybe you're psychologically pretty much, I can say, strong, but if you want to risk a lot, guys, that's gambling. I will always repeat, you can gamble in Forex market. Of course, you have bigger chance to win than if you go to casino. So for gamblers, I always say it's better to gamble in Forex. But guys, if you want really to trade professionally, then you should trade as institutional traders do. Like big banks, like institutional funds, hedge funds, pension funds, all those institutions who are risking huge amounts of money. Their risk is not big, and that's why they can really afford big positions with bigger stops. Because overall, you will see, if you really want to go with 5% risk per trade, or let alone, I can say, 10% per risk, it's nonsense. In the long run, you will lose. You will lose in the long run. Remember, you don't want to trade for 3 months or 6 months. You want to trade for 5 years, 10 years. You want to have a sort of income. Now, basically, also I need to state that from time to time it's good to have a challenge. For example, I myself have a challenge at this time. I want to do it. I want to trade $100 account to 3 stages. So $100 account to first stage is $1,000, second stage is $5,000, third stage is $10,000 out of $100 account. Now that is really a challenge, because it's very hard if you trade with $100 account, and especially if you're going with ECN, because usually minimum volume traded is 0.10 lots, so you really need to be careful. But I'm sure that if I do that challenge, I'm sure that $1 million would be definitely the same, because the thing is, it's not about the amount of money you trade. I will repeat it again. It's about the risk. Imagine, guys, without any single strategy, without any, I need to say, without any proven strategy, opening one lot, it's $10 per pip on $1 million account. You cannot lose that account. Really, how would you lose $1 million account by trading only one standard MT4 lot, let's say $10 per pip? It's almost impossible, because even if you wait for a long time, eventually you will be in a profit. Now, that's a theory, of course. Everyone can do that and everyone can know that. But the point is, if you are able to make, I can say, 10 times your account, so from $100 to $1,000, that means that you are doing things very, very correctly. That means that you can later invest $10,000 and try to turn $10,000 into $100,000. the same way you turned $100 into $1,000. That is a good thing, actually, because because most of us guys, really, not us, most of traders can afford $100, right? So if you want to present yourself with a challenge, then do it. Because if you manage to get to stage 1, that would mean that you made your account 10 times bigger, and the same way you can put bigger money at risk. So how trading firms do it? Principles of work, organization in a proprietary trading firm are this. Trading firms have an analyst which searches for trading ideas and securities, market research, trade analysis. Then there is a trader who is actually making a decision to open or close orders. Then there is a risk manager who does risk control, who basically calculate daily loss limit. Okay? That is how trading firms do it. So now imagine, guys, if trading firms have 3 different persons, and each of these persons here, analyst, trader, risk manager, has a full-time job within the context of a trading firm, that really makes you think, can you be those 3 persons yourself? Can you incorporate 3 different trading careers in yourself? Because when you trade, you are your own analyst, you are your own trader, and you are your own risk manager. Think. Trading firms have 3 different persons, at least. Your account has only 1 person, right? It is you. You are the analyst, you are the trader, you are the risk manager. Now that is why we always need to remind ourselves that trading is not just give me a system, trade it. No, that way you're just a trader, you're not a risk manager. It's not just give me a system, trade it, I will apply a risk, how I have been taught. No, because you're a trader and risk manager, but you're not an analyst. You cannot trade every single system from every single signal from your system. That means you need to be an analyst. It is not a coincidence, guys, that I publish my analysis every single day. But you can see it's not a coincidence. I don't pick trades randomly. I always scan for best trending pairs. I always scan for what Asia session did, what were major fundamental catalysts, and then I decide to publish the analysis on Admiral Markets, of course, and Forex Street. And it takes me approximately 1 hour to scan for pairs, and to do the analysis. With publishing, it takes me more than 1 hour. So in order to trade properly, you need to be an analyst. Okay, try to search for trading ideas. Do not take every signal from your system. It's a greed. It's not a proper psychology of a trader. Do the analysis. If you see that 2 pairs are having a good trends, and there is fundamental basis behind those trends, then try to search for signals with that 2 particular pairs. Be a trader. Make your own decision to open or close order at a particular level. Follow your system if it's successful, or follow a good analysis if you think it's a good analysis. And be a risk manager. You are in control of your risks. Do not let a human nature overwhelm your mind. Because human nature is to revenge trade, and to try to compensate for a loss as soon as the loss is made. Be a proper risk manager. Now, over leverage. What did I tell you 15 minutes ago? Your margin is your investment. Remember it. Okay? Try to detach your emotions from yourself. Now, most brokers will allow a very high leverage ratio. Or to put it differently, they have very low margin requirements. That's why profits and losses can be so great in Forex trading, even though the actual prices of the currencies themselves do not change all that much. There is a difference between stock trading and Forex trading. Stocks can double or triple in price, but currency never does. High risk, all or nothing is a very costly mistake. Okay? I know that basically if you want to start from scratch, let's say with a challenge I presented with $100, then you definitely need to have a high risk, right? All or nothing or whatever. But by learning from your mistakes, next time you will do it better. Because high risk is a very costly mistake. It makes you to think twice. If you have $10,000, it's really then usually you will do high risk trades because you have a lot of money, but I'm not sure that you will think twice. But with $100, you can afford all or nothing. And if you make a mistake, it will be a costly mistake, but you will learn from it. Definitely, you will pay attention to it. Because next time you put $100, I'm using that example because it's a challenge. It's not easy. It's easier to make $100 from $1,000 account than it's $100 from $100 account. So it will make you think twice because mistakes will happen. But you need to ensure that it doesn't eliminate your capital. High leverage works against a speculator. Always remember checking your heart rate. I know that a lot of traders lose 10,000s, and I personally had an email from a trader who lost 30,000 out of $50,000 account. I just told him a few things about proper risk management, and I told him never forget to check your heart rate because it will have a very negative effect on your well-being. Small losses are not dangerous. That is why if you can make $100 out of $100 and $1,000 out of $100, it's good, because if you make small losses, they're not dangerous for your psychology. Okay? Because every one of us has that human core of nature within our minds. The core of nature of the human nature is basically saying, okay, we are losing $1,000, but now think, guys, $1,000, let's say 10 pip loss is not big, but $1,000 is a huge, right? Why $1,000 for only 10 pip loss? Because we are over leveraging. I'm using an example just for the sake of the webinar, right? You have $10,000 account, but 10 pip loss, but you already lost 10%. You're risking too much. But if you lose 10% from your $100 account, it's nothing. It's same. Those are same 10 pip losses. But the effect of over leverage is huge. Because losses definitely tend to agonize beginners over bad decisions. Try to focus on the lessons from your mistakes. Don't agonize. Because you will drop in a spiral of doom. It can ruin your livelihood. Do not allow it. Do not forget that bankrupt firms such as Bear Stearns, Lehman Brothers, when they made losses in 2008, they had a leverage at the most of 35-1. That's why I'm saying the ultimate success in Forex trading boils down to a proper risk management. If you cannot create good returns with low leverage, this is the truth, guys. Forget everything what you have learned so far if you hadn't listened to me before. Because this is what I preach, this is what I teach, and this is the ultimate truth. Forget about other people telling you fairy tales. If you cannot create good returns with low leverage, expect massive losses with over leverage. Another reason why turning $100 in a $1,000 account is good. Because this case, you will assure that you will trade with low leverage. Because even if you lose $10, $20, human mind it's a miracle. It's something, it's the ultimate product of nature, human mind. And you will see, you will be happy even by making 10, 20, 30 dollars out of it. Because that means that you don't stress out for bad trades, and ultimately you are reaching towards your goal. Ultimately, that will mean that if you reach it, you can try to go to stage 2. You can make it with bigger money later, using same strategy, using same risks. As I said, stocks can double or triple in price or fall to zero, but currency never does. Never, guys. Lower margin requirement is less risky for Forex trading than it would be for stocks. One big advantage of Forex market, because lower margin requirement is less risky. It's great, actually. One of the reasons I prefer Forex to stocks is a lower margin requirement. Margin is called performance bond because it's the amount of equity needed to ensure that you can cover your losses. Okay? So, it's the amount of equity needed to ensure loss covering. There is no interest change for using the leverage on positions which are open and close inside a day. But do not forget that if you go with overnight trades, there is so-called swap. It's an overnight rate which can interfere with your leverage. Okay? The bigger the leverage is, the bigger the swap will be. So one more reason, do not forget to decide whether you will make an intra-week swing or intraday trade. Because the interest charge is only during a particular day. But using swap, it could interfere with it. Now, total equity equals to cash plus open position profit minus open position losses. For example, these are various examples. Margin is 1 divided by leverage. So 50-1 leverage yields a margin percentage of 2%. So this is a simple equation for calculating the margin. Okay, leverage equals to 1 divided by margin, which equals to 100 divided by margin percentage. Okay, this is another example of leverage calculation. Now, do not forget about pip value, because pip value is not the same for every pair you trade. Each pair has its own pip value. In most cases, pip value is equal to 0.1% of the quote currency. Let's say 10,000 pip equals to 1 unit of currency, and in dollars, 100 pips equals to 1 penny. 10,000 pip equals to $1. So guys, pip value, there are some indicators which can show you pip value, because pip value for euro dollar is not the same as for dollar yen or Australian dollar New Zealand. It's different. So it's different for Forex pairs. Do not forget it. Now, just for your consideration, let's say if you want to calculate your profits and losses in pips to your native currency, you must convert pip value to your native currency. Do not forget it. Now, rule of thumb is, by crossing 5% risk threshold, you are in danger zone. Do not do it. Unless you want to take a challenge, and sometimes you need to do it, but that's why you start with low amount of money. That's why you should start with, not with demo account, with $100, with, I don't know, whatever you can afford. And then when you raise your account, then you will see how you will respect this 5% risk threshold. Now, this is basically what I wanted to show you, also one of the examples. The quote currency, you probably know that the quote currency of a pair is the quoted price, but the value of pip is in the quote currency always. So euro dollar is 0.0001, dollar euro 0.0001 euro, okay? Now, if conversion rate for euro dollar is 1.1100, euro 1 pip is 1.000111. So this is the example of a pip value. Peter is asking, for UK-based people, could you relate lot sizes to pounds per point when spread betting? Well, Peter, you can basically use, try to Google for pip value indicator. Then if you have a pound account, then you just need to place it on your chart. I use MT4 for charting and trading. So it will probably give you a pip value of your account, so in pounds. So try to use it. I don't trade in pounds. I personally traded dollars and euros, and I traded pounds for that UK-based firm back in day. But the thing is, we didn't use lots, because I was trading on institutional accounts, and as I said, we could make one pip, let's say $1,000 worth, or we could make one pip $10 worth. So basically, we just calculated the risk. If your overall risk is 2% per day, then I advise using 0.5% per trade, because it would allow you for consecutive losses to reach only 2% of your overall daily loss limit. So always try to use this simple explanation which I will be giving you. Your first trade should always be lower in your risk. Because if you lose your first trade of the day, you will have a couple of more opportunities to cover for that loss, but staying within your risk threshold. I hope that you understand what I'm implying, what I'm saying. Always try your first trade of the day to be lower, because if you lose that trade, you can make up for it. Always, with still staying within your risk limit threshold. That is why your trade should never be 2%. per trade. Because if you lose at 2% per first trade, you cannot use bigger leverage to cover the loss. Simple explanation. Let's say that you use 30 pip stop loss and you lost 0.1 lot trade. Now next trade can be 0.2 lots and you only need 15 pips to cover for this. But even if you lose this one, you're still within your 1% of your risk limit. It's how you should do it. Because I know that a lot of teachers, educators, call it whatever you like, trying to explain you that you should use 2% risk per trade. Well, it's too much. It's too much, really. In the long run, it's too much. Because in the long run, at least once in, I don't know, a couple of months, you will do a revenge trade. You will be tempted to do a revenge trade. And this will make up for even a bigger loss. So basically, by applying lower risk for your initial trade, you are protecting your account from yourself, from your psychology. I have a free money management tool. If you're interested, I can send you. My email is tarantulafx@gmail.com. Basically, it's very simple. Risk percent is always fixed. So use whatever risk you deem it's correct. I use 0.5% of a risk. Then you enter a stop loss. Let's say you enter 30 pip of a stop loss. You press OK, and based on your account, this tool will give you proper lot size for your account, based on your account balance, based on your equity. So guys, this is a good tool. I can send it to you. It's a script, so you should put it in scripts folder, money management calculator. So if you're interested in that, just email me. It's free. I will send you. So this is everything I had for you today. I hope that you enjoyed the webinar. I hope that I have opened your eyes. And when someone tells you, try to make 20% per month, okay, you will know that you will not do that because it can kill your account easily. How do you check heart rate? Grab a heart rate monitor. It's very easy. Boyke is asking. Grab a heart rate monitor. Or use a mobile phone, put a finger on your sensor, and if you have a program, I'm using a Samsung S5, you have a program for checking your heart. But I don't do it because my risk is always low. So guys, thank you for listening to me. If you have any questions, always free to ask. If you're interested in money management tool, just email me. I will send it over. Thank you for listening. I wish you a very good week. And as always, guys, trade safe. Cheers.